Hey, deep divers, welcome back. Ever wondered what really goes into making sure a company's financial statements are trustworthy? It's definitely more than just checking the math.
It really is. Today we're peeling back the layers on audit engagements, like who does what, how they keep quality high, and yeah, even how they sniff out potential fraud. It's all about building that financial trust.
Okay, and you've given us some fantastic sources really diving deep into the nitty-gritty processes auditors follow. So our mission today is to unpack all of that for you, giving you a super clear picture of audit engagements, quality control, risk assessment, and how auditors work with a whole team. Get ready for some aha moments. All right, let's dig in, starting right at the beginning. How does an auditor even decide, if they want to take on a new client? Is it just like a quick meeting?
Oh, definitely not. It really starts with understanding who's who, specifically those charged with governance, or
It's
TCWG.
TCWG.
Yeah, they're the oversight folks. So management runs the show day to day, but TCWG oversees the big stuff, strategy, obligations, and crucially, financial reporting.
So that's like the board of directors.
Broadly, yes. Board of directors, the audit committee, very key player there. But TCWG can actually be different things depending on the company. Could be directors, maybe an external agency, or even just one owner-manager.
Okay, you mentioned the audit committee is key. What makes them so important? They seem to come up a lot as a safeguard.
They absolutely are. The audit committee is usually a small group within the board, typically made up of outside directors.
Meaning not employees.
Exactly. Not employees, not management, no big financial stake. Their main job, protecting auditor independence. They make sure there's a direct line between the auditors and the company's financial oversight, separate from management.
So they hire the auditor.
Yep, they select the auditor, set the fees, review the quality of the work, and make sure the auditor's recommendations actually get implemented. It's a really crucial check and balance.
And the auditors report to them, not management.
That's the key, especially for public companies where regulations mandate it. The audit committee approves the engagement, pre-approves services, and the auditors report directly to them. It fundamentally shifts the power dynamic towards independence.
Okay, so before that relationship even starts, the auditor needs to check if the company is, auditable. What are these preconditions they look for?
Right. Preconditions for an audit. Think of them as basic requirements. If these aren't in place, the auditor usually has to decline unless, the law forces them to audit anyway.
Okay, so what are they?
First, the company needs to use an acceptable financial reporting framework like GAAP in the U.S. It has to fit the company and why they're preparing the statements.
Makes sense. Rule book has to be right.
Exactly. Second, and this is huge, management has to explicitly agree to and understand its responsibilities.
Which are?
Three main things. One, preparing and fairly presenting the financial statements according to that framework. Two, designing and maintaining internal controls to prevent material misstatements, whether from error or fraud.
Okay.
And three, giving the auditor everything they need. Access to all relevant info, any additional info requested, and unrestricted access to people within the company. No closed doors.
That sounds comprehensive. Are there extra responsibilities for specific types of audits, like maybe for retirement plans?
Good question. Yes, definitely. For ERISA plan audits, those are employee benefit plans. Management has extra duties. They have to maintain the plan document, administer the plan according to its rules, keep participant records straight.
Okay.
And if they're doing a specific type of ERISA audit called a Section 103A3C audit, where some investment info is certified by a bank or similar institution, management has to confirm that certification is legit and presented correctly.
Got it. So what happens if management pushes back right at the start? Say they try to limit what the auditor can look at.
That's a major, major red flag. If management tries to impose a scope limitation that's so severe, the auditor couldn't even form an opinion on the financials as a whole, basically. Forcing a disclaimer, the auditor should walk away.
No exceptions.
Well, a very narrow one. If the law requires an audit and a disclaimer is acceptable for that specific type of audit, like some employee benefit plans, then maybe. But generally, it's a deal breaker.
What if the limitation isn't quite that severe?
Right. If the limitation would only lead to a qualified opinion, meaning everything's okay except for this one area, or if the limitation is due to circumstances outside management's control, like a natural disaster destroying records, then the auditor might still accept the engagement. But significant management-imposed limitations are usually unacceptable.
Okay, assuming all the preconditions are met, no major red flags.
Yeah.
How do they make it official? Just a handshake?
No, absolutely not. It needs to be formalized, agreed upon with management or TCWG, and documented. Usually this is done in an engagement letter or some other written agreement.
And the client signs it.
Yes, the client has to accept it, typically by signing and dating. If there's no agreement, the auditor declines. This letter is really important to avoid misunderstandings down the line.
What kind of misunderstandings?
Well, mainly about responsibilities. It clarifies that management is responsible for things like preventing fraud or maintaining internal controls, not the auditor. It sets clear expectations.
So what must be in that letter? The absolute essentials.
Okay, required contents. The objective and scope of the audit, the auditor's responsibilities, management's responsibilities, a statement about the inherent limitations of any audit, the fact that there's always a small risk, something material might be missed, the specific financial reporting framework being used, and a reference to the expected form and content of the auditor's report.
And other things can be added too.
Oh, yeah. Things like how fees are calculated, arrangements for planning, involvement of specialists or other auditors, communication plans, maybe even limitations on liability. For public companies, the engagement letter has to be agreed upon with the audit committee annually.
All right, okay. So that covers new clients. What about companies you audit every single year? Do they need a brand new letter each time?
Not necessarily a full new letter. For recurring audits, the auditor needs to assess if anything significant has changed that warrants revising the terms.
Like what sort of changes?
Maybe there's been a misunderstanding or the terms themselves need updating. Changes in senior management, ownership, the nature of the business, legal requirements, or even the accounting framework could trigger a revision.
And if nothing's changed?
If the terms are still appropriate, the auditor can simply remind management either with a new, simpler letter or even just a documented conversation that the previous agreement still stands.
Okay. And what if a company does switch auditors? How does the new auditor get up to speed?
That's called an initial audit. The new auditor, the successor, has a professional duty to make inquiries of the previous auditor, the predecessor.
A mandatory duty.
Yes, mandatory if the client gives permission. If the client refuses to let the successor talk to the predecessor, that's another big red flag. The successor really needs to think hard about accepting the engagement then.
What kind of things do they ask the old auditor?
Things like, was there any identified or suspected fraud? Any non-compliance with laws? Concerns about management's integrity? Were there disagreements about accounting or auditing issues? Why does the predecessor think the client changed auditors? It's all about getting background info.
And the predecessor has to answer.
If the client authorizes it, yes. They should respond promptly and fully. If there are reasons they can't be fully forthcoming, they need to state that. The successor documents all this.
Makes sense. Can an engagement ever change partway through? Like they start an audit, but then the client says, hey, can we just make this a review instead?
It can happen, but the auditor needs to be careful. They have to consider why the client is asking for the change. Is it a legitimate reason, like their needs changed or they misunderstood the original service?
Or is it something else?
Exactly. Is it because the engagement might uncover errors or fraud? Or is the client trying to create misleading financial statements? Those are unacceptable reasons.
What about scope limitations?
Right. If the reason for the change involves a scope limitation, like the client refuses to provide a signed representation letter or won't let the auditor talk to their lawyer, that's generally unacceptable. The auditor shouldn't agree to the change in that case. If the reason is acceptable, the auditor complies with the standards for the new engagement, and importantly, the final report doesn't mention the original engagement or why it changed.
Okay, so the engagement is accepted, the terms are agreed. Now, how does the audit firm ensure the work itself, across all its audits, meets the highest standard? It's bigger than just one engagement, right?
Absolutely. This is where the firm's overall quality control system comes in. It's the backbone ensuring consistent quality. Professional standards, like those from the AICPA, require firms to have a system of quality control covering their auditing, attestation, and even accounting and review services.
And the goal?
The goal is twofold. Make sure the firm complies with professional standards and legal requirements, and ensure the reports they issue are appropriate in the circumstances.
You mentioned a mnemonic for the elements of quality control.
Yes, it helps remember the 6 interrelated elements, HLPME: human resources, engagement client acceptance and continuance, leadership responsibilities, performance of the engagement, monitoring, and ethical requirements.
And how is this different from the standards for an individual audit?
Good distinction. GAS generally accepted auditing standards relate to the conduct of individual audit engagements, Quality control standards relate to the firm's overall practice. They provide assurance the firm as a whole meets its professional responsibilities.
Okay, let's quickly touch on those HLPME elements. Human resources.
That's about having the right team. It covers recruitment, hiring standards, making sure staff have the needed capabilities, how they're assigned to jobs, professional development, performance reviews, compensation, basically, everything related to personnel quality.
And engagement client acceptance and continuance. We touched on acceptance earlier.
Right. This element broadens it to the firm level. It's about having policies to avoid clients lacking integrity, ensuring the firm only takes jobs it's competent to perform, and complying with all ethical rules like independence before accepting or continuing with a client. It also includes documenting how issues were resolved.
Leadership responsibilities.
Yeah.
Sounds like the tone at the top.
Exactly. Firm leadership has the ultimate responsibility. They need to foster a culture where quality is paramount, valued over commercial gain. Their actions, policies, and resource allocation must demonstrate that commitment.
Performance. This is the actual doing of the audit work.
Yes. This involves policies for consistent, high-quality work. Think standardized documentation, proper supervision and review, confidentiality of client info, resolving differences of opinion within the team, and consultation with experts when needed. A key part is the engagement quality control review, an objective evaluation by an independent reviewer before the report is issued.
Okay, and monitoring. How does the firm check itself?
Monitoring is the firm's process for evaluating its own quality control system. Is it designed well? Is it operating effectively? Are reports appropriate? This involves things like engagement quality reviews, post-issuance reviews of files, and inspections.
And peer review fits in here.
Yes, peer review is a big part of monitoring for many firms. It's where another qualified CPA firm reviews the first firm's quality control system, typically every 3 years, for AICPA members. It provides external accountability.
Finally, ethical requirements. Seems foundational.
Absolutely critical. This ensures all personnel maintain independence, both in fact and appearance, integrity, and objectivity. It includes communicating these requirements, identifying threats to independence, getting annual confirmations from staff, and handling things like personnel rotation on engagements.
Well, that's a comprehensive system. It sounds like it generates a lot of documentation. How vital is keeping those records?
It's not just vital, it's fundamental. Audit documentation, the working papers, is the main record showing what procedures were done, what evidence was found, and the conclusions reached. It's the proof the audit followed GAAS and supports the final report.
What else does it do?
It helps in planning and supervising the audit, shows accountability, provides a basis for quality reviews, and assists future audits or successor auditors. Critically, it must be detailed enough for an experienced auditor, someone new to the engagement, to understand the work performed and the basis for the conclusions.
So who did what, when, and why?
Exactly. It needs to show who performed the work and when and who reviewed it. It should include things like copies of contracts, records of discussions, how inconsistencies were resolved, and importantly, evidence of professional skepticism, how conflicting evidence was handled.
How long do these records need to be kept?
There are specific retention periods. Under AICPA standards for non-public companies, non-issuers, it's at least 5 years from the report release date. For public companies issuers under PCAOB rules, it's 7 years.
Is there a deadline for finalizing the file?
Yes, the documentation completion date. After the report is released, there's a window, typically 60 days for non-issuers, 45 days for issuers to assemble the final file. After that date, nothing can be deleted, and any additions must be clearly documented as such. And regulations like Sarbanes-Oxley have serious penalties for improper destruction or failure to retain records.
Does the amount of documentation vary?
Oh, definitely. It's based on the auditor's judgment. Factors include the client's size and complexity, the specific procedures performed, the assessed risk of misstatement, the significance of the evidence, any exceptions found, and the extent of judgment involved. It's not a one-size-fits-all approach.
How is it typically organized?
Often into 2 main files. The permanent file holds things of continuing interest, long-term contracts, bylaws, organizational charts. The current file contains everything related to the specific year's audit, the audit plan, financial statements, the report, analyses, test results, confirmation letters, etc.
You mentioned tick marks earlier.
Right, those little symbols auditors use on work papers. Each tick mark indicates a specific procedure performed, like agreeing a number to a source document. And every tick mark needs a clear explanation in a legend. It creates that essential audit trail. For instance, on a bank reconciliation, you might see a tick mark meaning agreed to bank statement next to the bank balance.
Okay, moving on from the mechanics of quality and documentation. A huge part of auditing is understanding the client's business, and especially its internal controls. What exactly is internal control?
Sure, internal control is basically the whole system of policies and procedures a company puts in place to achieve its objectives. It's about managing risks and ensuring things run correctly.
What kind of objectives?
Generally, three main categories: reliability of financial reporting, making sure the numbers are right, effectiveness and efficiency of operations, running the business well, and compliance with laws and regulations.
And for the audit, which one matters most?
The reliability of financial reporting is definitely the most relevant to the financial statement audit. Controls related to operations or compliance might be relevant if they impact the financial data, but the primary focus is on controls that ensure the financial statements are accurate.
We hear the term COSO framework a lot with internal controls. What is that and why is it so significant?
The COSO framework is essentially the leading framework for designing, implementing, and evaluating internal control. COSO stands for the Committee of Sponsoring Organizations. It includes major groups like the AICPA and others. They developed this framework back in the 90s, updated it in 2013, really to help companies combat fraudulent reporting.
So it's a blueprint for good controls.
Exactly. It gives management and boards a common understanding of what effective internal control looks like, considering today's complex business environment. It provides confidence to investors and others. But it's important to remember, no system is perfect. There are always inherent limitations: human error, collusion, management override.
I've seen diagrams of the COCSO cube. What does that represent?
The cube is a visual model showing the relationship between the three objectives we mentioned: reporting, operations, compliance, the five components of internal control, and the entity structure, like entity-wide division function level.
5 components. You mentioned the crime mnemonic for that.
Right. Crime helps remember the five interrelated components: control environment, risk assessment, information and communication, monitoring activities, and existing control activities.
Okay, let's break those down. Control environment first. What's that?
The control environment is the foundation. It's the tone at the top, the overall attitude, awareness, and actions of management and those charged with governance regarding control. It influences everyone's control consciousness. It's about integrity, ethical values, competence, organizational structure, assignment of authority. The auditor evaluates this culture.
Next, risk assessment. But this isn't the auditor's risk assessment, right?
Correct. This is the company's process for identifying and analyzing its own risks to achieving its objectives. For example, risks related to preparing accurate financial statements. Where could things go wrong? Changes in regulations, personnel, IT systems, new business lines. These all create risks that management needs to identify and manage.
And the auditor looks at how well management does this.
Yes, the auditor considers if management's process is effective. If management misses a significant risk that the auditor identifies, it raises questions about their risk assessment process itself.
Okay. Information and communication systems. What does that cover?
This is about how relevant information, financial and otherwise, is identified, captured, processed, and communicated throughout the organization. The information system includes the accounting system, how transactions are recorded from start to finish. Communication involves ensuring everyone understands their roles and responsibilities related to internal control.
How does information flow?
The auditor needs to understand that flow from transaction initiation right through to inclusion in the financial statements. They look at the accounting records, the LT environment, how reports are generated.
The monitoring activities. How does the company check its own controls?
Monitoring is the process management uses to assess the quality and effectiveness of its internal control system over time. Are the controls working as intended? Do they need modification? This can involve ongoing activities, separate evaluations, or the work of an internal audit function.
So management's responsibility to keep tabs on it.
Absolutely. The auditor assesses how well management performs this monitoring function.
And finally, existing control activities. These are the specific actions.
Yes, these are the actual policies and procedures that help ensure management directives are carried out and risks are addressed. These are the controls auditors often test directly. We can use the mnemonic PAID tips for common examples.
Paid tips. Okay, let's hear them.
Sure. Pre-numbering of documents, think checks, invoices ensures completeness and prevents duplication. Authorization of transactions, approvals for purchases, payments, independent checks like bank reconciliations or comparing physical counts to records, documentation, maintaining the paper trail, invoices, shipping docs.
Okay, that's paid. What about tips?
Timely performance reviews comparing actual results to budgets or prior periods. Information processing controls IT controls like edits checks, access security. Physical controls locks, safes, security guards, restricted access to assets, and segregation of duties. This is a big one.
Segregation of duties, why is that so critical?
It means separating incompatible functions to reduce opportunities for one person to both commit and conceal errors or fraud. Think ARs, authorization, record keeping, and custody of assets. Ideally, different people handle each of these for significant transactions.
So one person shouldn't approve a payment, record it, and handle the cash.
Exactly. Separating those makes fraud much harder. The auditor focuses on understanding how these various control activities help prevent or detect material misstatements.
Okay, so with that deep understanding of the client and their controls, how does the auditor actually plan the specific audit work? What's involved in planning?
Planning is absolutely crucial. It involves developing an overall audit strategy and a detailed audit plan. It requires obtaining knowledge of the client's business and industry and performing risk assessment procedures to understand the entity, its environment, including internal control.
Is it a rigid process?
Not at all. Planning is continuous and iterative. The initial plan is based on early risk assessments, but it can, and often does, change as the audit progresses and more evidence is gathered. The engagement partner and key team members are heavily involved.
And supervision is part of planning.
Proper supervision of the audit team is required by standards. It involves directing efforts, communicating risks, especially fraud risks, reviewing work, and resolving disagreements. The level of supervision depends on the complexity and assessed risks.
You mentioned getting knowledge of the client's business. How do they do that, especially if it's a new industry for them?
They don't need prior experience before accepting, but they must gain that understanding afterwards. They'll use industry resources, AICPA guides, trade publications. For the client specifically, they'll tour facilities, review past financial history, understand their accounting systems and policies, talk to key personnel about current developments. It's about getting immersed.
Once they have that background, how do they develop the overall audit strategy? What's the big picture plan?
The audit strategy sets the overall scope, timing, and direction. It outlines reporting objectives, key dates, required communications, and the main focus areas for the audit. It includes preliminary thoughts on materiality and helps determine resource needs like staffing, use of specialists, timing of tests, and the budget.
What factors shape that strategy?
Things like the initial assessment of risks and controls, identifying significant accounts or locations, recent business changes, industry trends, and management's commitment to internal control. The strategy also considers the scope reporting requirements, locations, IT impact, use of service organizations.
Does this strategy get shared with the client's leadership?
Yes, the auditor communicates the planned scope and timing, including significant risks identified, to those charged with governance, TCWG. This helps TCWG fulfill their oversight role and can improve the audit. But the auditor is careful not to make procedures too predictable.
Okay, strategy sets the direction. Then comes the detailed audit plan. What's in that?
The audit plan translates the strategy into specific actions. It outlines the nature, timing, and extent of the planned audit procedures to be performed at the assertion level. A written audit plan is required.
What kind of procedures are we talking about?
Two main types. Risk assessment procedures, which we discussed, used to understand the client and assess risks, and further audit procedures, which are performed in response to those assessed risks.
And further audit procedures include?
They include tests of controls, checking if controls are operating effectively, and substantive procedures designed to detect material misstatements directly in account balances or transactions.
You always need substantive procedures?
Yes. Substantive procedures are required for every relevant assertion of each significant account balance, transaction class, and disclosure item. You can't rely solely on controls because controls have inherent limitations. These procedures include tests of details, looking at specific items, and substantive analytical procedures, looking at relationships and trends.
You mentioned relevant assertion level again. Remind us what assertions are.
Right. Assertions are management's claims, explicit or implicit, embedded in the financial statements. Remember, cover-up, completeness, cutoff, valuation accuracy allocation, existence occurrence, rights obligations, understandability presentation.
And auditors use these to design tests.
Exactly. They identify the relevant assertions for significant accounts, those where there's a reasonable possibility of material misstatement. Then they design procedures to gather evidence about those specific assertions. For example, for inventory's existence assertion, they might physically observe it. For completeness, they might trace receiving reports to inventory records.
So the written audit plan lists all these specific procedures.
Yes, it details the nature, what kind of test, extent, how much testing, and timing when to perform it for the planned procedures, often linking them back to the assertions being tested. And again, this plan can be updated as the audit progresses. For audits of large groups, the plan also details how the work of component auditors will be used.
And finally, how is this detailed plan communicated?
Similar to the strategy, the auditor communicates the plan's scope and timing, including how significant risks identified during planning will be addressed, to those charged with governance. It facilitates two-way communication and helps TCWG understand the audit approach, including the approach to internal control and materiality.
Okay, let's shift gears to something really central. Audit risk and fraud. These seem like the absolute core of what auditors are trying to manage. What exactly is audit risk?
Audit risk is the risk that the auditor messes up, essentially. It's the risk they issue an inappropriate audit opinion, like a clean opinion, when the financial statements are actually materially misstated.
And that risk exists because audits aren't perfect.
Precisely. Auditors aim for reasonable assurance, not absolute assurance. They don't check every single thing. So there's always a chance, hopefully a very low one, that a material misstatement slips through.
And a material misstatement could be an error or fraud.
Yes, it's an omission or misstatement big enough that it would likely influence a reasonable person's judgment based on the financials. It can be unintentional, an error or intentional fraud. Misstatements can be factual, no doubt it's wrong. Judgmental, disagreement over an estimate's reasonableness, or projected, an estimate based on a sample.
Is there a way auditors conceptualize or model this risk?
Yes, the audit risk model is fundamental. It states audit risk, AR, equals risk of material misstatement, RMM, times detection risk, DR. So AR equals RMM x DR.
And RMM itself breaks down further.
Right. RMM, the risk that a material misstatement exists in the first place, is seen as a combination of inherent risk, IR, and control risk, CR. So RMM, IRX, CR.
Let's unpack RMM. What's inherent risk again?
Inherent risk, IR, is the susceptibility of an assertion about an account balance or transaction to a material misstatement, assuming there were no related controls. It's the riskiness inherent in the item itself.
What makes something inherently risky?
Things like complexity, derivatives, subjectivity, estimates, susceptibility to change or management bias, or just sheer volume, high volume transactions. Cash is inherently risky. Obsolete technology or declining industry conditions can also increase IR.
Okay. And control risk.
Control risk, CR, is the risk that a material misstatement that could occur in an assertion will not be prevented or detected and corrected on a timely basis by the company's internal control. It's about how well the controls work.
Can control risk ever be zero?
No, because all internal controls have inherent limitations. Human error, collusion, management override. So there's always some control risk.
Yeah.
Auditors assess it as high if controls are non-existent, ineffective, or if they decide not to test them.
And critically, auditors don't set IR or CR.
Exactly. IR and CR exist independently of the audit. They characteristics of the client and its environment. The auditor assesses these risks, and that assessment might change, but they can't change the underlying risks themselves.
So in the AR equals RMM of XDR equation, what can the auditor control?
They control detection risk, DR. That's the risk that the procedures performed by the auditor will not detect a material misstatement that exists and could be material.
How do they control it?
By adjusting their own work. There's an inverse relationship between RMM and DR. If the auditor assesses RMM as high, meaning IR and or CR are high, they must set DR low to achieve an acceptably low overall audit risk.
And setting DR low means?
It means doing more or better audit work. They need to increase the persuasiveness of their evidence. This is done by changing the nature of procedures, more effective tests, the extent, larger sample sizes, or the timing, testing closer to year-end.
So high assessed risk means more rigorous auditing.
Precisely. But remember, even if assessed risk is low, auditors always perform some substantive procedures for all relevant assertions due to those inherent control limitations.
Okay, this leads directly to fraud. How does the possibility of intentional misstatement factor into all this?
Fraud risk is a critical component of RMM. Remember, fraud is intentional deception, unlike error. It generally falls into two types: fraudulent financial reporting, management cooking the books, and misappropriation of assets, theft.
Are there common warning signs or conditions associated with fraud?
Yes, auditors consider fraud risk factors, often visualized as the fraud triangle. 3 conditions are usually present when fraud occurs. 1, incentives pressures a motive or reason. 2, opportunity-weak controls allowing it to happen. And 3, rationalization attitude, the person justifying the act, or a culture that permits it.
What's the auditor's actual responsibility regarding fraud? Can they guarantee they'll find it?
No, they can't guarantee it. Their responsibility is to plan and perform the audit to obtain reasonable assurance that the financials are free from material misstatement, whether due to error or fraud. Because fraud involves deliberate concealment, collusion, and potentially management override, it's inherently harder to detect than error.
So reasonable assurance, not absolute.
Right. Management has the primary responsibility to prevent and detect fraud. The auditor's job includes specifically assessing fraud risks and responding appropriately, always maintaining professional skepticism, that questioning mindset. Don't just accept things at face value, especially if red flags appear.
Practically, how do auditors identify and respond to these fraud risks?
It's a mandated process. First, there's a required discussion among the key engagement team members, a brainstorming session about where the financials might be vulnerable to fraud. Second, they gather information through inquiries of management, the audit committee, internal audit, and others about their knowledge of fraud or fraud risks. They also perform analytical procedures looking for unusual patterns, especially in revenue. Third, they evaluate the fraud risk factors, the triangle.
What happens after risks are identified?
They assess the identified risks, what type of fraud, how significant, how likely, how pervasive. There's a presumption that risks exist related to improper revenue recognition and management override of controls. These must be addressed. They then evaluate the entity's controls related to these risks.
And the response?
The response has 3 levels. An overall response involves things like assigning more experienced staff, enhancing supervision, and incorporating unpredictability into procedures. Then, specific procedures are designed, changing the nature, timing, extent of tests to directly address the identified fraud risks. Finally, there are procedures specifically aimed at addressing management override, like testing journal entries, reviewing estimates for bias, and scrutinizing unusual transactions.
What if they find something suspicious during the audit?
They evaluate it. Any indication of fraud, even immaterial, requires follow-up and might suggest broader issues with management integrity. They assess evidence throughout, look for inconsistencies, and consider if the initial risk assessment needs updating. If significant fraud risk remains, they might even consider withdrawing.
If fraud is found or strongly suspected, who does the auditor tell?
Communication is key. Any indication of fraud, even small stuff, usually gets discussed with management at least one level above those involved. Material fraud gets reported to senior management and TCWG. Any fraud involving senior management, regardless of amount, goes straight to TCWG.
What about telling people outside the company?
Usually that's not the auditor's job due to confidentiality, but there are exceptions. Complying with legal or regulatory requirements like SEC filings, responding to a successor auditor with client permission, subpoenas, or reporting to funding agencies in specific cases. Documentation of the entire fraud risk assessment and response process is extensive and critical.
Audits, especially for big companies, sound incredibly complex. Do auditors handle everything in-house, or do they sometimes rely on others?
They definitely rely on others sometimes. It's often necessary to use the work of others to get sufficient appropriate audit evidence, especially when dealing with specialized areas or large decentralized companies.
Like using the client's own internal auditors.
Yes, that's common. Internal auditors are part of the company's monitoring controls. The external auditor gets an understanding of their function, competence, and objectivity.
But can the external auditor just hand off responsibility?
No, absolutely not. Internal auditors aren't independent. So the external auditor cannot share responsibility for audit judgments, materiality decisions, or the final opinion. Their work can supplement the external audit, maybe reducing some testing in lower risk areas, but it can't replace the external auditor's own procedures in high risk or subjective areas.
Can internal auditors help with specific tasks?
Yes, they can provide direct assistance, performing specific tests under the external auditor's direction, supervision, and review, but the external auditor remains fully responsible.
What about bringing in outside experts, like an actuary for pensions or an appraiser for art?
Yes, using an auditor specialist is common when specialized knowledge beyond accounting is needed for material items. This could be an actuary, appraiser, engineer, geologist, lawyer.
Can the specialist be someone from the audit firm?
Yes, they can be internal to the firm or hired externally. The key is that the auditor is using their work to obtain audit evidence.
What does the auditor need to do when using a specialist?
They need to understand the specialist's field well enough to evaluate their work. They must assess the specialist's competence, capabilities, and objectivity, check their credentials, reputation, and any potential conflicts of interest. They should agree on the scope of work, often in writing.
And then evaluate the specialist's findings.
Yes, carefully. They review the specialist's report, assumptions, methods, and source data. They need to determine if the work provides sufficient appropriate evidence. If the findings are problematic or suggest a misstatement, it impacts the audit opinion. But even if the opinion is modified based on the specialist's work, the auditor remains solely responsible.
What if the company uses a specialist, say, to value an intangible asset? Does the auditor just accept that?
No, similar process. If management uses a specialist, the auditor must still evaluate that specialist's competence, capabilities, and objectivity. They need to understand the work performed and assess its appropriateness as audit evidence. How much scrutiny depends on the risk, complexity, and potential for management influence. The auditor needs to be comfortable with the assumptions, methods, and data used.
How do IT auditors fit in? Are they considered specialists?
Good question. While IT auditing is specialized, an IT auditor involved in the financial statement audit is generally considered a member of the engagement team, not an external specialist in the same way an actuary might be.
So they're part of the core team.
Right. They assist in assessing IT-related risks and controls. The engagement partner directs their work but remains responsible for the overall audit opinion.
And what about massive companies with lots of subsidiaries? Group audits.
Yes, in a group audit, where the main auditor, the group auditor, oversees the audit of consolidated financial statements, they often use the work of component auditors who audit individual subsidiaries or divisions.
Who's responsible then?
The group auditor remains fully responsible for the overall group audit opinion. They need to understand and evaluate the component auditor's competence, independence, and the extent of their involvement. They provide instructions and review the component auditor's findings.
Can the group auditor refer to the component auditor in the report?
Yes. They can choose to make reference to the audit performed by the component auditor, indicating the magnitude of the portion they audited. But the group auditor still takes responsibility for the consolidation process and the overall opinion.
We've circled back a few times to material misstatements. Let's pin down materiality. How does an auditor decide what's actually material? What's the threshold?
Materiality is a judgment call, but a critical one. It's about the magnitude of a misstatement, including omissions that, individually or combined with others, could reasonably be expected to influence the economic decisions of users relying on the financial statements.
So it's about the user's perspective.
Yes. It's viewed from the perspective of a reasonable user who has decent business knowledge. It's not about finding every tiny error. It requires considering both quantitative factors, like a percentage of revenue or profit, and qualitative factors. The auditor sets materiality for the financial statements as a whole, using the smallest amount that could be material to any single statement.
I've also heard of performance materiality. How is that different?
Performance materiality is set lower than overall materiality. Think of it as a buffer or safety margin. Its purpose is to reduce the probability that the sum of uncorrected and undetected misstatements exceeds the overall materiality level. Auditors use it when designing and performing their detailed testing procedures.
And tolerable misstatement.
Tolerable misstatement is the application of performance materiality when performing a specific audit sampling procedure. It's the maximum error the auditor is willing to accept within that particular sample or account balance being tested. It's always less than overall materiality. For instance, if overall materiality is $100K, performance materiality might be $70K, and tolerable misstatement for testing accounts receivable might be $30.
Can these materiality levels change during the audit?
Oh, absolutely. The initial assessment of materiality is often revised as the audit progresses. New information might come to light, actual results might differ significantly from estimates used for planning, or changes in the company or its environment might alter users' perspectives. If materiality levels change, the auditor has to reconsider the audit plan and procedures.
Wow. What a journey through the audit process. From that initial client acceptance and agreement through quality control systems, understanding internal controls, assessing risks, dealing with fraud. It's incredibly structured and detailed work.
It really is. And hopefully seeing all those layers helps connect the dots to why audited financials are so important for decision makers. It's not just a rubber stamp, it's the output of a complex process designed to provide that reasonable level of assurance. Understanding that process helps appreciate the integrity behind the numbers.
So for you listening, the next time you look at an audited report, you'll have a much better sense of the ecosystem behind it. The responsibilities, the checks, the risk management, the skepticism, all working together.
Which does raise a fascinating question for the future, doesn't it? Given that audits have inherent limitations and fraud can be so sophisticated, how will technology, things like AI, advanced data analytics, continue to shape and maybe enhance these foundational audit principles? How can tech help auditors get even better at assessing risk and maintaining quality? Definitely something to think about.
Indeed. A great thought to end on. Thank you so much for walking us through all of that today. We hope you feel more informed and empowered with this deep dive.
My pleasure. Until next time.
Keep asking those great questions.